This meeting is being live streamed. What's up, folks? It is Tuesday. It's value after hours.
Is it?
We've got it doesn't make any sense. Don't worry about it. Just let it wash over you. Joined as always by Jake Taylor, and as a special guest today, we have Alex Morris, the science of hitting. How are you, Alex? Welcome to the show.
Good. 1 of the 10. Happy to be on. So we only have 9 listeners now, unless Bill's listening, I guess.
He's not.
Okay, we're down to 9. Sorry to hurt the numbers.
Good to see you, Alex. Glad you could make it.
Yeah, I was putting some journalistic notes in this morning, so
attaboy.
We'll see how those pan out in a couple of years.
All right, what are the odds that they're going to be embarrassing? That's always a good question for.
Pretty good.
Strong to quite strong.
I had a notebook that I kept for a while, and one of my journal entries that I remember was Microsoft, which thankfully I still own today. But I remember I wrote, "It's at $25. Fair value is 32." I was very confident that the fair value was 32. I don't remember why or how I got there, but thankfully I didn't listen to that in hindsight.
Yeah, what was that, like 5x ago?
It was a while ago. Yeah.
Let me do some shout outs.
Tell me where they coming from.
Townsville strong in the house today. Craig and Dino in Townsville. What's up, fellas? Arkansas, Seattle, Jamaica, Milwaukee, St. Louis, Madison, Concord, Norberg, Poland, Stirling, Scotland. How about that? My brother's middle name is Sterling. Auckland. The Azores. This is a great spread. How's everybody doing?
Excellent. Yeah. How's the? Oh, that was rhetorical for the audience.
That's for the audience. Rhetorical. Yeah.
Okay.
How was how's the reaction to the journalistic launch last week?
Very
strong to quite strong.
Quite strong. Yeah. I was pleasantly surprised. Lots of people creating accounts and getting in there and doing some real work, and lots of good feedback, which is exactly what we need right now. So it's been fantastic. Been very thankful for everyone's energy and participation and sharing it. And I think we might be building a pretty solid community here as well. So there might be a lot more features coming that would allow some more interaction.
I've been using it for a week. My performance hasn't improved at all. JT, when does that happen?
Well, just stop then right now.
I think I'm down.
Yeah.
I'm down over the week. Give up. So I got a few topics this week. This is this is not a whole topic, but the 10-3, the Treasury, the 10-3 is either yesterday or Friday was the most inverted it's been in the data going back to 1982. I get that that's a short period of time, but I don't know if steepness in the inversion means anything. I don't know if it's relevant or not. I'll just sort of bring this up because it has been a pretty good predictor of recessions in the past. And if you go into a recession, you get a much bigger drawdown in the market. I don't actually do anything about that trading wise. I just sort of watch it just because it's like slowing down on the freeway, knowing that there's a big accident further up ahead. I'm not going to do anything. I'm not changing anything. I just sort of know that it's coming. Anyway, it makes me a little bit nervous, but be some good buying opportunities when it rolls around.
I looked at it after you talked about it last week, and the only conclusion I came to is that I was very confused by what I was even looking at. I don't understand most of this stuff very well, but it certainly was confusing / a little bit scary to me to see what I was looking at.
I don't know what.
Hard to imagine though, Toby, that there's
more slowdown coming.
Well, is this the most telegraphed recession and market crash in history if it was to show up? I mean, almost by definition, since everyone knows it's coming, does that mean it can't come?
The thing is, the market's not off that much. Like the S&P 500's only off like 15% since the start of the year.
That's fair.
Given what's happened over the last few years with that bubble run up, and then, on some measures, the most expensive market we've ever seen. People can debate the efficacy of CAPE or Tobin's Q or those other things, but they do seem to be very, very stretched. And they have spent a long period of their history below the mean. And these things run back more than 100 years. Maybe we've entered a brave new world where margins are more easily managed and capitalism doesn't compete as ferociously, but it doesn't feel like that to me. So at some stage, margins compress, P's will start looking a little bit stretched because the earnings are down. And then even though the market's down, it still looks expensive. Maybe there are better opportunities elsewhere. I don't know how it works, but I get that sentiment view too. Like I don't talk to anybody who's not, the average person who I talk to is just like, yeah, there's a big crash coming. So that's not like that's new news.
Yeah. It's a real variant
it's not
perception
helpful.
there.
It's not helpful at all. Like it's not like you can use there's a big crash coming to do anything. It shouldn't change your behavior. The only reason I do it is because I just want to be mentally prepared when it happens. I've got my buy list ready. I know what I'm going to do. And so when it happens, you don't get the adrenaline pumping. You just like going through the plan that you have to buy stuff, knowing that you probably buy something and sell it cheaper because there's something that's better value down there, and don't worry about it. Just keep on going through. The worst thing you can do is panic at the bottom and pull all your money out, which is I've seen lots and lots of people do. So I just try to get my head right before we have the car accident, know what I'm going to do.
That's a very good idea. Like have your man overboard plan ready to go.
Yeah.
Don't wait until you're in the heat of the moment.
Yeah. One of the things I've struggled with this particular time period is completely understanding that comment and having some sense of normalized economics. They might come in if macro's tough. Knowing what normalized is for a lot of the businesses I'm looking at has just become really tough in the past 2 to 3 years. And for a lot of names or industries that I definitely wouldn't have predicted at the start of COVID, having major headwinds, tailwinds at different times, that in some of the cases, I can't even explain them today, basically. So that makes life a little difficult.
Yeah. Doesn't like COVID feels like we all have to like knock 10% off of our circle of competence, like across the board, basically, like just understanding, being able to predict like what industry competitive dynamics look like. I think you got to be really kind of take some of that in your confidence and just recognize that like, boy, this is tough right now.
It's tough to tease out the secular and the cyclical. It's always tough to tease out the secular and the cyclical, but particularly this time, like to what extent will work from home persist? And then what knock-on effects does that have for commercial real estate, very, very high-end commercial real estate? And then within that, there's also a business cycle going on. It's very, very hard. I don't know that anybody can figure that out, but it'll cost you money one way or the other.
On that topic, it's funny. It seems like most companies have, from what I've seen, kind of pulled back a bit on the idea of, hey, you can work remote full-time forever. That will be your job. Outside of Airbnb, which is a company that continues to say, we think this is a competitive advantage for us to be able to hire anybody anywhere and give them a significant amount of flexibility. It'd be interesting to see how, I mean, maybe there's other companies doing it, obviously, but I'll be curious to see how that kind of experiment plays out for them over 5-10 years.
Do you think that that's because they are, because of the nature of their business, that they have to be seen to be doing that?
Chesky, the CEO definitely, he's lived on Airbnb at various times. I think he might be doing it now even. So it certainly plays into his idea of, what's possible, but obviously different levels of the organization have different roles and responsibilities that may require being there in person. So I'd just be curious if it's actually applicable on a much broader way than, the CEO.
Yeah. If you're an office REIT managing one of those, does everyone have to come back into the office? We're all remote.
Yeah. I wonder if something like, Microsoft, Google, because I don't know if you guys remember, but before COVID, Yahoo was working remotely. Yahoo was doing a lot of remote work. And when Marissa Mayer came in, she said, no, we're stopping that. You guys aren't doing any work. You're all back in the office. And that was a big, like that nothing saved Yahoo. That obviously that wasn't the problem, but it's funny that was they were trialing it. Didn't work. Couldn't get it work for Yahoo. If it doesn't work for Yahoo, I don't know who it works for.
Yeah.
It's a brave new world.
I've got the GMO paper. We don't have to do that now, but I've got GMO came out with a recent bit. I should get the title because it was good.
And I've got a topic called The Invisible Present, and also a fun story from last week when I was up in Seattle. So we've got a full lineup today.
So with the 10-3 inversion, do you guys still do the innings anymore? I haven't heard Bill talk about the innings for what. Are we going backwards? How does that work?
It's your bill today, so you have to be the one who tells us what inning we're in.
Oh boy. We're an extra World Cup edition. We're in extra time. We're running out of time. We're almost at PKs. We're getting close.
It's funny because the 10-3 that I saw somebody like the average period of time. So the 10-3 inversion, once you've got 10 consecutive days, so I guess they're business days, so 2 weeks, then there hasn't been a period of time where a recession hasn't followed over the last 50 years, but there's only 8 instances where the 10-3 is inverted followed by a recession. So it's not statistically significant, but it's an interesting kind of fact pattern. And the thing that we were talking last week was a little bit about whether it was not predicting so much as it was like illustrating that there was a problem. It was an expectation of deflation because it did exist. Evidently in the 1800s, the paper that I tweeted out showed that inversion was the ordinary course, it was ordinarily inverted. It wasn't was it backwardation, contango, normal backwardation? Oh, I've got that around the wrong way. I don't know. But the inversion is unusual today, but it was not unusual at all. And the reason was, well, the interpretation in the paper was that they had a lot of deflation. So perhaps it indicates deflation or it predicts deflation. I don't know, but it's inverted right now. And the average period of time from inversion to the recession is 10 months. So that would be like August, September next year.
This is treasuries, right, that we're looking at for this. Is
3-month treasury and the 10-year treasury.
Is there any sense as to how clean or dirty market signals are today with intervention? Like, is there a finger on the scale?
Yeah, that's interesting. I don't know. But there's always been a finger on that scale, right? Well, since
I guess
1913. They've always participated in that market, haven't they?
I would imagine. Not true? Yeah.
Yeah, I think the commentary from some of the retailers has been interesting in terms of just general sentiment of consumers. I mean, everybody from, DG and Walmart on one end are more grocers than anything else and skew a little bit lower end. And basically the commentary is food and beverages, driving all of the sales as inflation and cost and price increases. Basically, there's not really volume growth there. It's just pricing, and that's offsetting general merchandise to the extent that exists. On the other end of the spectrum, Costco comments yesterday from the CEO saying high-end TVs, stuff like that. I think his comment was the consumer today is more value conscious than they've ever been before. So interesting comment for obviously at 2 different ends of the spectrum in terms of, income levels, right? So
ever been? That's actually a pretty bold statement.
That's what he said. Yeah.
There's a lot of it feels like there's a lot of unprecedented stuff in the data over the last few years, just because that run up and then the run back down has made it so hard to predict. So everybody's overbought or bought in too much inventory and they had to get rid of inventory. Like now the shipping's coming back to normal.
Mm-hmm.
Well, we were talking about that on this podcast, and I think, do you remember, JT, when they said they would clear that backlog that was off Los Angeles? Did they say it was end of 2022? Because they've got that right, if that was the case, mid 2022.
I thought it was projected to go out even farther than that back then, but I don't know.
They seem to have done pretty well there.
Probably should have written that down somewhere.
Well, it's recorded in a podcast. There's a transcript.
Yeah,
it's somewhere.
That's amazing to have cleaned that up. I mean, that had to have been not the easiest thing in the world to figure out logistically.
I guess you just keep on working on it. The interesting thing about the recessions and stock market performance, though, that often the declaration of a recession is the bottom for the stock market.
Because it's backward looking and it's already cat's out of the bag.
Recession is looking backward. The recession call is backwards looking, but the stock market is forwards looking. And it's one of the, it's the sequence of economic data is HOPE. So it starts with housing, there's O and P, whatever that stands for, and then employment goes last. I haven't bothered looking it up yet.
I love the
refuse to.
fact this is like the 5th time we've talked about that acronym, and you still haven't bothered to go look and see what the O and P are.
Because you only need to worry about 2 of them. You only need to worry about the H, and the H is clearly rolling over pretty hard at the moment. The E is employment is still very strong. And that's the thing that if you hear any commentators talking about it, they'll say, oh, there can't be a recession because employment's really strong, not realizing that the recession...
It's the last.
Yeah, it's the last thing to go. And when they actually, when employment peaks and you start seeing losses, that's when the stock market takes off. The stock market will rocket at that point. So it's sick. Like it looks like the stock market's celebrating the fact that people are getting fired, but I think it's more to do with the stock market's looking forward, and they know that as soon as that cracks, and in any case, that's backwards looking data. So when that cracks, it's typically better times are ahead.
For the love of God, someone in the hive mind, please look up what that O and the P is. Like I can't do this for another week.
Do you want me to do? Do you want to do the GMO paper? There's just one interesting factoid from the paper that I just wanted to bring out. That I thought it was kind of interesting. So this is their quarterly letter, and they're explaining the deep value. So they say the deep value is very, very cheap. They divide the universe into 5 quintiles. So a quintile is 1/5, and then they rank them from 1 to 5, where 1 is the most expensive. That's all of the growthy type stocks, and then 4, and then the 5th is the cheapest, so the value type stocks. And then they looked at their relative valuations to their own histories. And so the most expensive stocks, even though they're off a lot, they're still trading in the 88th percentile of overvaluation, which I think is kind of amazing. The second quintile is in the 90th percentile of overvaluation.
So this is the most expensive we're talking about? So
the most expensive is in the 88th percentile of overvaluation.
Yeah. Okay.
The second quintile is the 90th percentile of overvaluation. The third quintile is in the 97th percentile of overvaluation. So that's the market, probably. The fourth quintile, so this is the second value bucket. This is in the 70th percentile of overvaluation. But if you get down to the cheapest bucket, it's in the 4th percentile relative to its own history. So that's why you've seen this huge, I've been talking about the spread, like this massive spread for a while now. It peaked at the end of September, I think, and it came in October for the first time. And you can see that in this data a little bit. So basically what GMO is saying is that deep value is super the only place that's really undervalued. Yeah.
Sick. You know what? After I read that, I went and looked a little bit. I was trying to dig into some of can I confirm that anywhere in other data? And one of the places I looked was the ETF RZV, which is the small cap value. It's just a plain vanilla small cap value. And when I've owned it at different points in the past, and it was, when I looked at it, it was at 8.6 PE trailing and 0.95 price to book, which to me is like kind of like a normal price for small value. Like it's probably around 1 times price to book typically, or maybe a little bit more than that. But like I've bought it at times where it was down at like a half of price to book. So that's like 2x from where I've purchased it before. So that like doesn't quite square with that 4th percentile cheap bucket in my mind. But one thing that was interesting was that the ROE on the RZV was actually like 12.5%, which I thought was quite a bit higher than I would have guessed. Like that's a lot higher quality. So maybe that's part of it. I don't know. Like clearly we're like looking at different data slices somehow. But to me, like it didn't seem quite as cheap as I would have expected based on GMO's observation.
Yeah, how have they determined their value? Oh, I've just lost the...
They probably use some kind of multi-factor or multi-measurement, value peanut buttering. But still,
if you want something to be optimistic about, I remember a Goldman report a few years ago that said we were at the 99th percentile in terms of valuation. So now you said the middle bucket's 97 now, right? So we're getting cheaper.
So you're telling me there's a chance?
It's funny how little it's moved, honestly. It's funny to go and look at it and see. Every time you feel I feel like the market's, it's been in drawdown all year long. No, we've at various stages, we've been down 20% or so. And I don't check it that often. So I went back in and had a look and I was like, oh no, it's like it's hardly moved. It's hardly off because it's bounced so much from that October low.
Well, if you're using earnings, but I don't feel like that the fundamental has rolled over to keep at a similar valuation level, right? The ratio. So I don't know. You're right though. It doesn't feel like this like super bomb out certainly yet.
I've got an update on the acronym. Do you want to hear it? John Borchardt.
Yes,
Hope.
please.
Housing, orders, profits, employment. Orders and profits.
Orders. Okay.
Yeah.
Huh.
Oh, was
And
it?
profits.
I've already forgot what you said they were.
Housing goes
Housing-
first, employment goes last.
There you go.
Orders,
That's all you need.
profits, employment.
Brad says RZV wouldn't be bottom decile. The 4% was the bottom quintile. Yeah. So what is RZV? It's the half, right? They're divided in half. There's a RZG and an RZV.
I suppose, yeah, that might be a factor.
The question is whether they do it by count of stocks or whether they do it by like some valuation index. Because I think that's been a problem for some of those value ETFs that have that style of creating them, that they haven't had enough stocks to put into the V bucket. There's too much stuff that's doing too well. So it all ends up because I think that they tend to put some momentum overlay in there as well. So it pushes a lot of stuff into the momentum, the growth part of the ETF.
A lot of ways to slice it, huh?
Indeed. Do you want to do your bit, JT?
Sure. I thought I would start off with a little story that was kind of fun. I was up in Seattle last week and celebrating with a little bit of the launch with my co-founders. And I also happened to meet up with our mutual friend, George, Toby, and I got a chance to actually meet Li Lu, which was quite an awesome experience. Very effervescent, very personable, high energy. Just actually like, it was weird because I came away from it and I was like, oh, that was cool. And like that night. And then the next morning I woke up and I was like, wow, that was actually really cool. Like it took a little bit of time for it to sink in. And eventually I was like, man, that was like better than I would have ever expected. So they always say don't meet your heroes, but in this case, Li Lu came through in a big way.
Jealous,
So,
envious.
yeah,
That's awesome.
I would have been as well up until last week, but pretty awesome. Okay, so you guys want to do some vegetables? So this one comes from, shout out to my boy Paul in Ireland who sent me this article that's from the Long Now Foundation, which we've done a few of their things before. I like them a lot because they're trying to get humanity to think in longer timeframes, which is, I think kind of near and dear to my heart. But one of the things that they do that I always find funny when you're reading one of their articles is that they put a 0 in front of the years. So it'll say 0, 2022 to get you to think about like, well, someday it's going to be, 10,000, 2022. So I find that to be, it's always a little off-putting when you first read it because it's like, wait, oh, that's supposed to be a year. But then when you remember again what they're trying to get you to think about, it's kind of fun. So let's paint a little picture. For 9 months of every single year, there's this guy named Chris Halsh who every 2 weeks will walk this same 10-mile loop near Donner Pass, which happens to be in my backyard. And it's high up in the California Sierra Nevadas. And his sole purpose when he's out there every 2 weeks is to count butterflies. And he visits 5 different sites at different altitudes. And with this metronomic regularity, he's out there for the past 5 years counting butterflies. And every time he retraces his steps, he's jotting down which species and the number that he's seeing. And it turns out that these notes that he's taken are actually highly coveted by scientists. And he types them up in a spreadsheet, and every single data point adds a new segment to this really long chain of observations that's been growing without interruption for more than half a century. And it's these exact same places that they're measuring and these really long-lived efforts to monitor the butterfly population. And it's kind of like a relay race where now, Halsh is the one who's extending this run, this marathon that actually started 20 years before he was even born. So these type of like multi-decade time series observations they're really rare, and they're they're very valuable artifacts in measuring ecosystem health because they overcome this particular weakness that we have in our ability to perceive the natural world. And, we've developed all these powerful methods for looking at past events that, could have been like the birth of galaxies billions of years ago, mass extinctions millions of years ago. We have instruments now that will measure and parse the present down into these tiny, tiny slivers of time that we can measure. They call them zeptoseconds. But when it comes to this modest time scale of our own lives, we're almost basically blind. So, for instance, scientists have been tracking atmospheric CO2 at the Mauna Loa Observatory in Hawaii for 64 years. And we right now will use tree rings and ice cores and sediment drilling samples to capture sometimes data that are millions of years old. And there's kind of some fun stories about there's locals in Finland have been keeping the freeze and thaw dates of a particular river for 325 years. So we have some pretty good idea of some of the temperature changes for that particular area. And of course, Japan, we've talked about longevity in Japan before, and they have some data series that are measuring the flowering of cherry trees and when did that happen? And it goes back 12 centuries. They have these notebooks from monks who are keeping track of when the cherry blossoms happened. And so it's back to 800 AD. But the problem is that our perceptions are often distorted by, we have really selective memories and cognitive biases, sometimes political agendas. And one of the most difficult parts of this is that we have this shifting baseline syndrome, where whatever sort of the recent past has been will influence what we think is normal. And, each generation kind of gradually forgets the conditions of the past and we accept the new ones as completely normal. And so in this, there was an essay by the zoologist named John Magnuson, and he wrote about this kind of temporal myopia that we get trapped in what he called the invisible present. So that's what I'm calling this segment. And it's this space where we can't see the slow changes and we can't see the effects because often they're lagging years from their causes. So, and one of the issues that right now in science is that there tends to be these 3-year grant cycles. So if you wanted to have a long longitudinal study, you can't get the funding for it because there's nobody to pay for it further out than about 3 years. And so, we end up with these thousands of snapshot studies, that look at a single hurricane, but it won't look at what happens cyclical damage of hurricanes over 30 years. That type of analysis just doesn't get done. So I thought it'd be kind of interesting to think about what's the invisible present to us today in the investment world that we're missing out on. And these shifting baselines, they mean that we start ignoring the past and accept the present as normal. And we get used to it. We start taking it for granted. And what would appear right now today to be anomalies in a bigger, longer data set? So the first thing that comes to mind is interest rates for me. The relative present has been these incredibly low rates, but that seems like an historical anomaly. And yet we all sort of I think everyone's waiting for rates to go back down to 2%, right? That's we just think that's going to be the new normal. And I wonder about that. Multiples, obviously, which are often driven by that interest rate. We kind of got used to getting 30 or 50 times revenue for a SaaS company. Is that going to come back, or was that an anomaly? Profit margins, we talk about this on the show a lot. Has this 12, 13, 14% profit margins? Is that the new normal? Or is it that's the historical anomaly because 6% used to be the normal? And then factors, obviously, values dead, those type of arguments. But historically, if you look back further, that it tended to work out pretty well. So, a little bit of self-promotion, but these time series data are really hard to just remember. And it's really dangerous, I think, to do this kind of work all in your head. So you should probably be keeping a journal. It's pretty impossible to remember what you were thinking in the past in high fidelity, and to keep track of the changes. And one of the biggest problems is that the business effects can lag their cause by multiple years. Bezos famously said, he'd get congratulated on a quarter and he would say well, I can't really take credit for that because that was all stuff that we did 3 years ago that's finally showing up today. And it's just simply too hard to keep track of all that stuff in your head unless you're writing it down. I would say the short research grant cycles of academia today are analogous to short-term horizons in the investment world. It's really easy to be blind to these slower developing but important trends when you're only thinking a few months out or the next Fed cycle or, and then it's shocking when you read about these crazy percentage of options today that are being trading that are like really they're termed out in hours, not days or weeks or months, right? Like it's this insane kind of gambling instinct that's still taking place.
Well, that's exactly what it is. Otherwise, you don't get the satisfaction of getting your answer straight away.
Yeah, exactly. And then Toby, of course, like you have these value charts that go back hundreds of years, but it's really easy to dismiss it today that, all that stuff is not applicable to this new digital age. Price to book's been discarded because intangibles, are the new normal in the business world. So
it's having a good year.
Yeah, well, yeah, maybe that's the anomaly. I don't know, but I think we all have to be thinking in these, thinking about our longitudinal data sets and how applicable are they to today, and what's the new normal and what is not the new normal? And I think that if you can get some of that stuff right, I think the game gets quite a bit easier.
Yeah, I think a great example. I was listening to a portion of the 2004 Berkshire meeting before we hopped on here randomly, and a question was about corporate profits as a percentage of GDP, and Buffett's answer was basically technology is just as likely to make that better as it is to make it worse, and effectively said, the real beneficiary of the GDP growth over time, a lot of it goes to the consumers. And you can think of that comment being said almost 20 years ago now, and thinking how long even the largest, most well-established media, I mean, they're really just getting there now, kind of, in terms of what was being seen late 90s, early 2000s. It's only now, and obviously it's still reshaping and will continue to reshape, but it's a good example of, it takes a long time for these things to play out. And there is an open question still whether or not are the companies the beneficiaries, are the consumers? Is there a reasonable mix? What's the actual breakdown there?
Who's going to have to share those economics with their customers eventually? I'm fairly confident over a long enough time horizon that eventually that it almost all goes to the consumer. It's just a matter of how long does that take and how much profit is there available to the producer surplus in the meantime.
And you can layer on top of there a political version of that same idea, which is 20 years ago, M&A that might be able to get done, is that still applicable today? Or has the political regime or thinking on these topics changed in a way that fundamentally impacts industry structure over long term?
Yeah, what do tax rates look like? That's also another, they're quite a bit lower than they were 20 years ago.
Yeah.
Before we got on, we were talking about, do you have that Galbraith quote off the top of your head, JT?
Oh, yeah. Something like financial history teaches us that over the short term, we learn a lot. The medium term, we learn a little bit. And the long term, we learn nothing.
It is funny how often these, like the tech boom cycle repeats over and over again through the history. And it's just funny, like every human being who's ever been alive has known that they are, modern humans at the very pinnacle of civilization. It's just that the technology has changed along the way, right? Like in 1825, it was steam engines, steam ships that became steam trains. 1844, it was the telegraph, and so on. Like in 1969, it was electronics. The late 1990s, it was .com 1.0, and then this last boom, I don't know, SaaS or .com 2.0 or something else. And there'll be another one in the next 10 or 20 years that'll be completely plausible in the moment and won't seem like a bubble at all until it's well into it, and then it gets swept away and the valuations go crazy. It'll happen again. It's funny. Like I saw my first day of work was April 2000, which was the crash, but I was at university and I remember seeing it. Just was exciting and interesting, all of the sort of .com stuff that was happening. And then it was a value cycle that ended with like that leverage buyout boom, that all those gigantic leverage buyouts getting done, with like Stamzell selling into the biggest buyout ever done. And
you getting sucked in as a value investor at that
well,
point?
it turns out we were value momentum investors.
it was
We were just
working.
riding the train. Yeah, we were just on what was working. And then and tech was cringe as hell through that. Everybody, like people pitching tech ideas, were just laughed out of the, like tech was trading at like 3 times EV/E, but I was buying tech companies for nothing and worried about them because I didn't think they were going to make it. And then you get this new cycle. Tech will be cringe again. Tech is getting cringe now. It'll be hard to raise money for tech in a little bit. And then, coincidentally, that's probably the best time to be investing in it. And we'll probably have a financial run here that'll end with more tears, and then it'll be on to the next cycle. It just happens over and over again. You just got to try not to get too blown up.
Go ahead.
That's it.
There's a great quote from Klarman along the ideas of, everybody who starts in the business in a certain window has certain views about stuff. And it takes that 5, 10, 15-year period for that to wash out and, restart again, basically.
I think that's true. I think that's
different
true.
ways. Yeah.
I think
Makes sense.
Hussman also says something like you should measure from peak to peak or trough to trough. And I never really understood why that was so important until I've been through a few of them. And I was like, yeah, you can really get funny results if you measure from a trough to a peak or a peak to a trough. You really do need to be aware of where you are in the cycle as you, even looking at business results. Like it's not just stock price results.
Yeah.
Yeah.
Do you have more, JT? Do we?
I'm spent.
That was a good one.
I think another one that probably applies to what you're saying that I am not smart enough to talk about other than to just say it is probably, geopolitical and globalization and everything happening, which seems like a lot and obviously could potentially be changing pretty significantly as we look ahead, which would probably be very bad for the world. But that seems like another notable one.
Yeah, the fall of the Berlin Wall felt momentous. I was 10 when that happened. And I'd like grown up watching Rocky and Rambo and all this
all that propaganda.
And so it was funny when that happened. I was like, there's no bad guy anymore. Yeah. They remade Red Dawn.
But was it the Chinese or the Russians at that point?
Yeah, I don't know. Could have been North Koreans. Like you can't criticize China because that's a big export market. You got to find some country that doesn't buy.
Hollywood's
doesn't watch the movies.
Cozied up with them.
North Korea gets a hiding. It's like 20 million people living in the Bronze Age. At least you're probably going to beat them. Easy segue from there. Oh, one other thing I wanted to raise was the Cape. Cape is a good example of that, JT. Like Cape over the last 25 years has a much, much higher mean than the full set. The full set mean is like 16. I think it might even be pushed up to 17 now because of the last few years. But even then, that's way, way below where it's traded for the last 25 years. And the funny thing is that when Schiller wrote his paper, it was 1996. And that's coincidentally the last time that it traded at the mean. And it took off.
That was irrational exuberance.
And then it took off from there. And it's never traded. Like I think in 2009, it like touched the mean. March 6, 2009, touched the mean and bounced off it like a golf ball off a concrete path.
Yeah, that was if you were using Cape as a timing tool, that was a rough go for you there, because you would have thought for sure in that environment you're going to go below the mean for a little while, right? You'd have to.
I mean, I thought so. I guess interest rates like
good thing you're not a macro guy.
Oh, you'd be out of business. I don't know how you do it. I guess you just have to hold a little bit of every asset. Like you have to do it like asset allocation. I think that's the only way to do it, right?
Well, what's the point?
I assume
after that, might as well just index and go home.
But you get to be a macro hedge fund dude.
Talk about it.
Go on CNBC, tell people what you think.
It is sexy topics if you can get in there and really just spin some yarns about macro stuff.
But you do need to read something like Super Forecasters before you do it. You need to get into that and then realize how wrong you're likely to be.
Oh God, the track record is no bueno there.
It's not
any names. A few are popping in my head, but I'm going to keep.
Oh, they all are. Like they all are. Everybody's right 1 time in a row. You get famous for being right 1 time in a row, and then you take your pick, like Rubini or the 538 guy, like all those guys. They get one thing.
Silver.
Like if you took the entire universe of newsletter writers, there's somebody in there who's got the right. Somebody is right now for the right reason, completely coincidentally.
And never again.
Well, as a
What?
newsletter writer, I'll take my one run if I can get it. So hopefully it's Mitch.
Yeah. One time for daddy.
I just want to be right once.
I'll take once. It's fine. It sounds pretty good right now.
Yeah, no kidding.
Someone asked, do you take the S&P 500 reversion to the mean model to pick tops and bottoms of the cycles? I think it would be very hard because that's one thing I know. It's like I love.
You would have been cash for 2017, 18, 19, 20, and then finally felt like you were half right in COVID.
I used to do this little model where it would kick you out when you got to some new level of overvaluation on the Cape, and it would then kick you into
treasuries or something.
Yeah. And so when the treasuries were yielding 6%, many times that was a great idea because you earned 6% for a year when the market went down 20.
That's the Munger model, huh?
That's a good model. But the problem is that
how'd it do lately?
the problem with it has been that Cape has just got progressively more expensive over its history. And so whatever, you had to find some way of dealing with whatever the overvalue. No, that's not right. Always crashes 2 standard deviations above the mean. It doesn't. Whatever absolute level you set for Cape, it's got more expensive each time before it's actually managed to crash. So you can't be doing it backwards looking. It doesn't work as a timing. Valuation doesn't work as a timing tool. Can't be forced to work. Alex, how do you feel about you said you looked at Home Depot? You got some
give us some thoughts on that.
Story on Home Depot.
I've been looking at Home Depot recently. I'm writing it up now, and I just thought it's a fascinating business / stock story. And the business story is if you want to take the last 30 years and kind of split them into 2 parts, the first half, you start in the early 90s, they have about 200 stores. You jump forward 15 years and they're at like 2,200 stores by the mid 2000s. And obviously, the market liked that a lot. And, by the early 2000s, it's trading at, call it 50 times forward, something like that. Then 2000, obviously financial crisis comes around, business gets hit, honestly, to less of a degree than I would have assumed. It's like low single digit comps or low to mid single digit for about 3 years. But obviously you could imagine it being much worse than that during that period. The bigger thing from strategic perspective is the company comes out and says, we're not going to build stores anymore. We're kind of saturated in terms of what we think we should be doing. We're going to focus on the economics inside the 4 walls, what we already have. Obviously, other investments there like supply chain, remodeling, et cetera. But the market did not react favorably to that idea, at least at the time. It's a 10, 12 times earnings type of stock. Earnings at that time were around $2. And it's just a fascinating story in terms of you fast forward to today. Earnings last year, obviously there's pandemic stuff in here, but earnings last year were about $15.50 compared to $2. The cumulative increase in the store count over the past decade is less than 5%.
Wow.
It's just a fascinating share buybacks are part of it. Honestly, the bigger driver is just significantly improved unit economics.
Yeah.
And, there's a great interview with Frank Blake, used to be the CEO, who effectively says, excellence requires intense focus. And you just think about a company that's, at 200 stores, gets to 2,200 over 15 years, was expanding internationally, had different concepts besides the core Home Depot box. You can imagine in real life, unlike in a financial model or spreadsheet, you can get spread pretty thin in terms of resources and managerial attention, et cetera, et cetera.
Build that empire.
So, yeah, exactly. So long story short, $60 stock at the turn of the century. A decade later, a $30 stock, and today it's like $320 or something like that.
Crazy.
What
and
do you know
a
where
good
the capital
addition
came from for the build out to go 11x store count?
I think a lot of it was internal,
Just
as far as I know.
internally?
Yeah, I'd have to look at I don't know if I have share count going back to the 90s or not, but I think a lot of it was internal, and the economics were very attractive. A good addition to the story is Home Depot started in late 70s in Atlanta. They opened stores in South Florida pretty soon thereafter. My dad's a plumber and we live in South Florida. He didn't buy the stock at that time. He did buy the stock around the turn of the century
when it was hot.
And he eventually sold it around 2008, 9, 10, somewhere in that range. So it was, right in his wheelhouse in terms of circle of confidence. And
he's in there every day.
He's in there every day, and a strikeout on that one. Sorry, Dad, if you're listening.
I thought it reminded me when you were talking about the transition from growth to, they said they weren't going to build any more stores. It just reminded me of this. There was this Australian mining company executive, kind of wildcatter type dude, who was the actual miner behind it. And they had a big boom in the 80s, and then they got religion in the 90s about not spending so much money developing all of these mines. And he said that as they got they got the discipline to make sure that their mines ran more efficiently, and they didn't spend money doing silly acquisitions or any of that sort of stuff, they lost the blue sky speculative multiple that they had, and they went and started trading like a value stock. And so the guy was like, people, they want us to be out there spending that money. Like the stock market tells us to go and do that. And it's funny the number of times now that I think that I've seen that in stocks. Funny though, when you think about something like Google doesn't get any credit for like that crazy blue sky stuff that they've got going on. Their other bets, Alphabet's other bets.
Real quick, only because it ties into that perfectly. The Home Depot co-founders wrote a book in the late 90s, and there's a section in the book, and this is the period where they're starting to expand international, new concepts, etc. They say specifically in the book, we had to try to expand and do these other things because we wanted to kind of keep the high multiple that we become accustomed to, which is hilarious because it's a book where you read it and the whole way through you're like, everything here is like gospel to me, and it reads perfectly in the way I think. And then you get to something like that, it's like, this is the exact opposite of what I
behave
want.
Irrationally. Behave irrationally to get the higher multiple, but then you can use that higher multiple to do sensible things.
Yeah. And again, it was a business that, as far as I know, most of this was just internal funding one way. I mean, if anything, they were repurchasing shares. So it was something where you would, at least in theory, prefer it to be the other way. But at the same time, it might be different in their case where their co-founders still running it, own equity, et cetera. You can see how, like the Disney situation right now, you can see how stock price, your long-term vision better align with your shareholders and your board and everybody else. Because if it does, there's other problems there besides that, but it certainly is part of the story as well. So it's an interesting theory versus practice discussion on some of this stuff.
It's interesting to watch someone like Buffett with Berkshire, because Berkshire has gone through lots of different cycles where it's been loved and hated. And when it was loved last, when was it loved last? Probably in the late 1990s, do you think, JT, or more recently than that?
Yeah, I would say like the real hard love. I would say like probably 98 when he did the Gen Re swaparoo. That was pretty genius.
Yeah, that's what I was going to raise too. That was as the last time when he sort of used overvalued stock to kind of do an acquisition where, he overpaid, but he was overpaying with overblown stock anyway. So from his perspective, he was like, that is a bargain. That is
maybe
cheap.
BNSF a little bit too. Like they used some stock for that one, I think. And that was probably, if you look at the profitability of that company versus probably like the growth and profitability of Berkshire shares, which is how you should think about when you're trading your company for someone else's company. That was probably a pretty savvy move as well.
Railways were just hated for a long time there. Buffett just picked that up right at the perfect moment, because there was a great blog post that came around afterwards, and I don't know who did it because it's too long ago now, but they pointed out how much money he pulled out in that initial period. He basically got back a third or a half or more in cash over the first few years of that acquisition. Kind of amazing.
Yeah. Speaking of Buffett and kind of what you were saying before about the Australian company, Oxy is a really interesting example of, the company very clearly spelling out capital return policy and growth expectations. And my read on the situation when I look at it is that certainly played a big part. And, they have to actually hold themselves to it now, which is the hard part, right? Everybody can say in a down cycle what they're going to do when there's opportunities to grow again. But so we'll see.
That's the genius of Buffett, though, is that he points it out publicly and even calls out the slide.
That's it.
Tie-in management to the mast.
That's it.
Genius.
It's interesting, though, that's what attracted him to it. He was like, well, we're at this point where they're going to be returning capital. I think that's an interesting model to think about. When he doesn't like the super high growth, he likes it where they get to the point where they're like, we don't need capital anymore. We're going to be returning capital. We built it all out.
Yeah. Not only that, they specifically put a cap on production growth. Like there is no if, and, or buts about what the capital allocation policy here is. And to JT's or to your point, like Buffett wants people to know that and management to stick to it, I assume.
I did see an interesting paper that talked about like why oil or energy won't drill from here. And the basic tenets were ESG, like there's still pressure ESG wise from investors to not have more drilling. Engineering wise, the engineers are still telling like management, like, let's save our tier 1 assets for later. Like, there's no point in drilling in them. And then when you look at the math of whether it makes more sense to drill that next marginal well or buy back your shares for cheap, like the returns on buying back your shares, it's kind of a Tobin's Q type of mentality where it's buy versus build. And the buyback makes way more sense than the next drilling. And that probably is going to go on as long as it stays cheap for ESG reasons. So I find it to be interesting. I'm not sure why that would be wrong. I know eventually like they'll all lose religion, but it's probably not at prices where we are today. I don't know.
Boone Pickens made exactly the same observation about raiding in the 80s, I think. He said it was cheaper to drill for oil on Wall Street than it was to go and actually drill for oil out in the oil patch.
Smart.
There's also that somebody's pointed out, Ron Zola pointed out in the comments that the shale assets, do they seem to put a cap on where the oil price can go? Because they're high cost assets, but at some point north of that, everybody starts drilling. And then that caps a little bit because you get a little bit of a flow. Did the shale actually produce any oil? Or did it produce any returns? Does anybody know? I thought that it didn't. Like, I thought that we were like net negative on money invested in shale. That might not be right.
No, that's something like I think Bethany McLean said at one point.
She's a good source.
Saudi America. I think that was her book. But I don't know how, like the start and stop time of the measurement for that would probably be pretty important. So it was probably true for some time period. I don't know if it's still true.
I was just reminded, I think I tweeted this out after the podcast, but Value Stock Geek has this has a newsletter that he sends out, and he had this little tidbit in there that I thought was kind of interesting. That Buffett paid $400 million for Dexter shoes, and he's complained about it in a few letters about the fact that it didn't make money or that it lost some money.
And Dexter then Value Stock, money? You mean I think so, yeah. Went away?
Anyway, yeah. But he said that if he'd put the same $400 million in Nike, it'd be $20 billion today. Isn't that crazy?
Whoops.
Pretty wild.
It just like often I sort of fantasize about going and starting some enterprise, like a Berkshire Hathaway type thing, like everybody does, right?
Can I be your vice chairman?
I want to be the vice chairman.
No. I want vice chairman.
I'll be Mark Hamburg or whatever the CFO's name is now. I assume it's still him, but I'll take that job so nobody knows any clue who I am. Just pay me.
That's a good job.
Yeah, that's a good job.
Probably gets paid $75K.
No, I think those guys actually make a lot of money.
But don't you? Okay. Every time I think about doing that, I remember this. Like I had the same idea when I was a young lawyer doing private equity transactions, and the private equity, it's just so much work to do an acquisition, right? There's so much paper.
You just wrote it on the back of a napkin. Isn't that what Buffett does?
I've never seen anybody do it like that. They like produce these 3-ring binders full of the acquisition agreements. There's like 20 binders full of acquisition agreements, for all of the debt and all of the assets and everything. It's complicated. And then you're stuck in it. You can't get out of it. Like it's that hard to get out. At the same time, you find the same asset trading on the stock market for like 3 times earnings with no takeover premium.
And you can get in it for $5 in your Schwab account.
And then that you wake up tomorrow and you made a mistake, you just push a button and get back out. But you can still have those returns. Like if you're going to be, if you get the Dexter shoe and you stick it into Nike instead, which seems like Dexter shoe should be this hidden asset, right? And Nike's like, everybody knows what Nike is. Everybody knew what it was 20 years ago whenever he bought Dexter shoes. And that here we are 20 years later, it's run up. Is that it's run up 40 times? That's crazy. 40, 50 times. It's run up 50 times because it was 400 million.
It does speak to the just absolute amazing gift that public markets are to the individual investor, and the ability to transact so cheaply in world-class businesses and have all the information available to you that's available to everyone else. What a godsend, really.
Yeah.
Yeah,
Absolutely.
those opportunities are just sitting out there in plain sight. Like Apple's another one. When Buffett did that Apple transaction, everybody knew what Apple was. It had been cheap
Never
3
heard of
times
it.
in the last few. That was late in the run, right? It's not like you're picking it up when Steve Jobs comes back or when they introduce the iPhone or the
Right.
iPod or those like fruit colored computers. You're getting it way, like everybody's seen it forever. It's one of the biggest companies around. And then you
And
put
yet-
a third of your money into it and it pays off like that.
I don't know if he said it immediately after when it was first disclosed or later on, but the comment about that real estate being more valuable than Fifth Avenue. That was
Yeah.
in specific numbers, obviously he didn't say that, but it was a pretty smart comment in hindsight.
Yeah, that was smart. And a 30% rake on that real estate as well.
Yeah, it's not
Wow.
bad. Not bad if you can get it.
And yeah, but that's Bill's point. Bill's in the comments here, but that was his point too. That you finally got his toll road, right? Got his toll road on every bit of transaction that happens on the internet.
A lot of cars going across that one.
Crazy.
Wow.
30 cents out of the dollar too.
Do
you see that? Can that?
Right?
Yeah, that's what I was going to. Can you see that last thing? That's got to be broken at some point. Regulatory.
It's too win-lose to stay forever. I mean, right?
How do they get
Seems
around
like
it?
Nature finds a way.
Yeah, good point.
It's amazing to think this has been going on in some capacity, obviously for a while, but just publicly, how many companies that pay them hundreds of millions of dollars a year, Match, Spotify, plenty of others that are just very
Twitter.
publicly coming. Yeah, just very publicly expressing discontent with the current. And it's just kind of a funny, I can't think of other topics that are really like that, if any. Companies tend to keep these things kind of behind closed doors, right?
It's funny to see.
We live cut to the FTC and they're like playing solitaire on their.
It's funny to see. Oh, sorry, I just completely blanked. I was reading Billy's comment.
Sorry, I interrupted.
Yeah.
Got time for a question or two for Alex, especially.
Just say real quick, Match Group CFO, if you want to read somebody who's the most optimistic on something changing, he's a good person to read, and he does a good job of covering what's happening in different jurisdictions and the like. I still don't believe that they actually have the proper read on what's going to change or when, but we'll see.
They feel that it should, or they feel that it will.
They feel that it's starting to effectively. They certainly feel that it should as well, but they've had funny enough, they had a bit of a tussle with Google, and Google ended up putting out a public blog, which I thought was very interesting, where they essentially trashed them and then sued Match, which is obviously a big company that pays, again, hundreds of millions of dollars in app store fees every year. It's very interesting to see. I was surprised that Google would do that if it's like a last throes of this is going away, or them feeling so confident about the position that they're willing to publicly kind of slam, again, a big company, customer, whatever you call them. It's just odd.
I remembered what it was that when Twitter was having its fight, when Musk said that Apple had pulled some advertising. And so his solution was to go and build a competing phone, which don't want to laugh at someone like Musk. Clearly, he can go and build competing things that are very, very successful. But it's not like that strategy hasn't been tried before. Like Google's out there with a competing phone that's pretty good.
Microsoft had a
hard
phone.
to get. Yeah, everybody like that. Samsung's still out there with a phone. You can get. Wall Street Journal did this article on it, and you can probably still find it out there somewhere, where they just went to China and got a Wall Street Journal phone put together. The reporter got the phone put together. Like it's trivial. You go and tell them what you want. You want the camera and all the bits and pieces that you want in there, and you're probably going to get an Android operating system. And so we could have a value after hours phone if we wanted to. There could be a Tesla phone would be just a completely trivial exercise at this point. But I guess it's hard.
That's the case that goes on the phone, Toby.
The problem with my phone is this: you see all those things inside the phone. That's the thing that you need to make it work. Folks, we are coming up on time. This is going to be our last one for 2022 because I'm on vacation in Australia. Probably try and do a meetup some point for any Aussies who want to come down. Anybody else is welcome too from anywhere, but it's a long flight. That's the only thing. What are you up to for the break, Alex?
I am heading to San Diego for a week, which should be fun. And then I will be, after finishing up Home Depot, I will be looking at Floor and Decor, which is an interesting kind of smaller retailer that I've been meaning to look at for a while. The firm I used to work at in Georgia actually had a couple ties to the company, so I know a little bit about it from when they went public. But seems like a pretty interesting concept that I don't know enough about right now, but I'm very interested to learn more about.
Floor and Decor. What do they do?
Floor.
They do floor and decoring. No, they do. I think it's mostly, I guess you would call it like more commercial relationships. You might go in there and pick something out, but they're dealing with a contractor or someone like that, is my understanding. It's not you going in there and buying those type of things. So I know very, very little about it at this point, but having looked at Home Depot, I'm excited to dig more into that space. So
what about you, JT? What are you doing for the break?
Gonna go to Mexico with the wifey for about a week, which is much needed. Just the two of us getting away. We haven't gone anywhere without the kids in pre-COVID, I think. So it'll be nice. And then then just home and making the magic with the kids, magical memories like we try to do. So
that'll be fun.
Is this the Journalytic international launch? Are you saying that right now, or
for tax purposes? Yes.
That's where HQ's at.
Yeah. Well, we're thinking about shifting it to the Bahamas. That seems like a good spot for stuff. I
think some real estate's opening up.
Non-extradition treaty.
Yeah, non-extradition treaties are nice. Apparently, the banking rules are pretty lenient.
Evidently,
do whatever you want.
That's fun. Well, thanks for all the love and support this year, guys. We'll be back early next year. So take it easy, everybody. Thanks, Alex, too, for filling in for Billy.
Yeah, thanks, Alex.